Hi everyone, this is a technical analysis on the S&P 500. Let's start with some fundamental background first. Last week was the Jackson Hole Symposium week, and we have heard from many Fed members about their opinions on the monetary policy going forward. There seems to be a consensus for a pause in September as they try to carefully assess the lag effects of their tightening to date. Nonetheless, they are ready to do more if conditions require further tightening, and in fact, they keep reaffirming their data dependency. The economic data since the last FOMC meeting has been surprising to the upside, with the labor market remaining very strong. But the last two inflation reports show the core month-on-month inflation rising by just 0.16%. Overall, it looks like a soft landing scenario, but the latest US PMIs show that there might be pain ahead. On the daily chart, we can see that the S&P 500 bounced around the key support at 43.24 and rallied into the 21 moving average. The sellers were waiting for this pullback, leaning on the moving average, and pushed the price lower again, targeting a break below the support. The bias for now remains bearish as the price has been printing lower lows and lower highs, and the moving average are crossed to the downside. On the 4-hour chart, we can see that we got a breakout of the downward trend line into the 44.94 resistance and then a quick sell off back below the trend line. This might have been a fake out, and generally what follows is a continuation of the original trend. Therefore, the buyers will need to break above the trend line again to invalidate the bearish setup and position for a rally into the 44.94 level again. On the 1-hour chart, we can see that the quick sell-off from the 44.94 resistance broke through the black counter trend line, with the price then extending the drop towards the previous low. We got another pullback here into the downward trend line where we can also find the 50% Fibonacci retracement level for confluence. This is where we can expect the sellers piling in with a defined risk above the level to target the 43.24 support first and eventually new lows. The buyers, on the other hand, will need to break above the trend line to validate the bearish setup and push the price to new highs. This week is an important one, given that we will see many key labor market data, including the US NFP, before the next FOMC meeting. We start tomorrow with the US consumer confidence and the US job openings. On Wednesday, we have the US ADP report. Moving on to Thursday, we will have the US jobless claims and the US PCE data. Finally, we conclude the week with the US NFP and the SM manufacturing PMI on Friday. Although the Fed keeps all the options on the table, it's also leaning more towards a pause in September, so we will need strong data to make the market to expect a high at the upcoming meeting.